Have you ever thought about becoming your own bank? I mean, what does that even mean? Well, that's what I want to talk to you about in this video. I want to teach you who is a good candidate for a whole life insurance policy, but more specifically, not just a whole life insurance policy. I want to talk to you about how you can be your own bank, because the whole life is just the machine we use. It's the process that you need to understand. So first off, let's just go through some basics here. Let's define what whole life is. Not just the type, but what it is. It's a life insurance policy that lasts your whole life. It has two components. Number one, it has a death benefit, but it also has a cash value. Now, depending on the companies, but if we use a mutually owned dividend-paying whole life insurance company, what they're also going to do is pay you a dividend, which is a return of the premiums not used, which is awesome because they give you money back every year in the form of dividends. The other thing you get in a whole life is a guarantee. A guarantee that when you die, they're going to pay a death benefit. But most importantly for what we're going to talk about, and that is being your own bank, a guaranteed interest rate. That should be music to your ears. Because I can tell you the guaranteed interest rate that the insurance companies pay you on your money is way better than what the banks are not paying you on your money. So, we can design a whole life to do lots of different things. Don't come to me for this, but you could go to an agent and say, I want to buy a whole life for death benefits specifically. I want pure protection for my entire life. I don't ever want to outlive my insurance, i.e. term insurance. Most people, 98% plus, will outlive their term insurance before it ever pays out. Whole life, no one will outlive because it lasts your whole life. Matter of fact, to outlive a whole life policy, you'd have to live to 121 years old, and you still couldn't outlive it because the policy would endow, meaning they would pay you all of the benefit at 121. And you could just go buy an island. So it can be designed for death benefit. But what else can it be designed for? Well, it could be designed to be used as a machine for the infinite banking concept. That machine would basically be where we put our money and where we take our money from for opportunities. Things like buying cars, investing in real estate, lending money out, anything, loaning money to your company. It goes on and on. But the way we design the whole life policy is very different, and it very much impacts the commissions paid to the agent or advisor. So if we design it for cash value, for being your own bank, the commission will be 60 to 90% less than designing it for death benefit, where the commission will there be 60 to 90% more than the way that we do it for being your own bank. And then the other thing that we need to determine is there's just not one way to design it for cash value and being your own bank. We need to determine what problem are we solving with the whole life design. There's lots of problems. So we might be paying debt off, or we might be buying a car, or maybe you want high early cash value for real estate opportunities that you might have immediately. Each one of those requires a different type of design for the policy. And I'm not saying one design is better than the next. Each design solves a specific problem. So until we determine what your specific problem is, we can't really design it the proper way. So let's get a little deeper into this. So, is the person saving the money, or are they willing to save for a future goal? Let's just draw this out, right? Let's just say your goal, and we're going to keep this super simple, is you want to buy one of those brand new pickup trucks. You want a brand new, whatever, call it a 2500. I should make the tires a little bit bigger on that one, okay? This is what you want, and that thing is going to cost you $80,000. So this is our goal. Now, don't mark me for the picture of the truck. I could get better, but we're just doing this for an example. So first thing, we have a goal. We know we need $80,000. So over on this side, what we need to do is we need to plan to save $80,000. Now I know there's 4 different ways to buy vehicles. We could pay cash for it, which is what I'm going to show you. We could finance the vehicle, which I'm also going to show you, but not in the traditional sense. You could lease the vehicle, in my opinion, one of the worst ways to do it, or you could steal that $80,000 pickup truck. It's your choice on how you want to buy it. But let's just assume that we're going to save. So each year, if we want to save for this, let's say we're going to save $20,000 a year. I don't care if you do that monthly or annually. It doesn't really matter how you do that. Essentially, that means it would take roughly 4 years to save enough money. But that's okay because the vehicle you have now, you plan on keeping for another 4 to 5 years. So this is perfect. So we save this $20,000 and we go and we pay cash for the truck. This is a traditional way that somebody would do a cash purchase. Okay, because in doing this, the cash purchase, you saved 80 grand over 4 years and you bought the vehicle for 80 grand. All is good and done, nothing changes. And because you paid cash for it, you don't have a monthly payment. But what if all we did is changed just one thing, folks? What if we changed where your savings went? Instead of putting it in a traditional bank, we put it in one of these specially designed whole life policies. So I'm going to put specially designed whole life. So every year we put $20,000 in premiums into this whole life. But remember, this whole life is designed for early cash value because early cash value is in 4 years we want to buy that truck. Okay, so let's see if I can do a better job with designing this truck. Put the big hood scoop. There you go. Okay, so there's your pickup truck we're going to design. Now, what we're going to do is when 4 years goes by and we have 20 grand, you're actually going to have more than 20 grand because you will have been paid interest plus dividends each year. So chances are you're going to have more money in this account than you would have in a traditional savings. We're then going to take the money out to pay cash for the truck, except for we're not going to take the money out like we did on the first one as a withdrawal. What we're actually going to do is we're going to take it out as a loan because we want to act as the bank. Okay, remember we said that, BYOB. We want to be the bank. So when we take the loan from the policy, the $80,000 that we put into the policy, all of that money is still working for you. Even though we just took $80,000 out to buy this truck, you would think if you started with 80 and you took 80 out, but you probably have 84, 85 in there. You get the drift. If we had 84 and we took 80 out, how much is left in your policy? Most of you are thinking 4. You're saying, okay, 80,000 minus 84,000 means there's 4,000 left. Wrong. The loan that we took was a loan against your death benefit. Okay? Your death benefit is what the loan came against. So the insurance company loans you $80,000 from their general account, which means you still have $84,000 sitting in your policy. So now you took the $80,000 out, you bought the truck. Because you took a loan against your death benefit, the insurance company is going to charge you roughly 4 to 5% on that loan, okay? Depending on the company. You're like, oh, that sucks. But what if over here your $84,000 was earning you 6%? Would that suck that you were paying 4 or 5 when you're making 6? No, because you're making a spread. Now, these numbers may not be your exact numbers. It's very dependent on the design and also the policy and the company we use. But now what we're going to do, this is very important, so pay attention. This is who this is for. We're then going to treat our money the same way we would have treated any other bank's money if we were to have financed the vehicle. I know we paid cash for it, but did we not take a loan from our bank? And if we took a loan from our bank, should we steal money from our bank? No. If you owned a business or you owned your own bank, you'd never steal from your bank. So what we're going to do is we're going to figure out a monthly payment to pay back to our bank. Now, this sounds bad, right? You're like, oh, first off, I don't want to take a loan. That's my money. I saved that 84 grand. Why would I take a loan? Because that loan never needs to be paid back. They're just going to subtract the 80 grand from your death benefit. So the loan never needs to be paid back. Yeah, but you said that they charge interest. Yeah, but they're paying you more than what you're actually paying them. So you're making a positive spread. So now, to make this whole thing work as your own bank, you got to treat your money the same as you treat the bank's money. So let's just say that an $80,000 car loan for 5 years would be $1,600 a month. So what we're going to do is every month we're going to put $1,600 back in our policy. This is going to be recapturing the money that we normally would have given away to somebody else. By doing just this, taking a loan from your bank, allowing your money to grow without any interruption, because remember, we started with 84, we took 80 out, but we still got 84 earning interest and dividends, making a positive spread over the interest you pay the insurance company. Now we take the $1,600 that we would have paid to someone else's bank, and we pay that back to our bank. Now here's the cool thing. The $1,600 you pay back to your bank, okay, that money repays the loan, which means $1,600 a month is now available in your bank to be used again. Isn't that cool? When you finance a vehicle from somebody else's bank, the $1,600 payment is gone forever. All you got is a depreciating truck. In your bank, the The $1,600 payment you pay back to your bank is $1,600 your bank has the next day when your check clears. Isn't that really cool? Plus you get a spread. So what problem did we just solve with this equation? We changed one thing, where the savings went. What problem did we solve? We showed you how to buy a vehicle and get all the money back for that vehicle over time. The next vehicle you buy, you'll even get more back. So the other factors that come into this are how old are you? What is your health? So this isn't going to work for everybody. First, you got to be able to save money because we got to be able to put money into this specially designed whole life. Second, age doesn't matter with this, but anyone over 68, it's not going to work as well. So I would say draw the line at 68 to 70 and over. This is going to be hard to make this work for high early cash value. And the last thing is, you got to look as good on the inside as you do on the outside. Your health matters. So if you've got underlying medical issues, if you had cancer in the past, if you got something really serious, the insurance company is going to uncover that. Because obviously they're on the hook for what? A death benefit. And if you're going to die too early, then they're not going to give you the policy. So those are some other factors to include into that as to what it is that you need to make this system work. Folks, I hope you like this. And if you did, check this video out. How much money do I need to get started in that infinite banking concept? In other words, how much money do you need for one of these policies? That video will show you, so check it out. And while you're at it, down at the bottom, click that little subscribe button. And then like this video and also click the little alerts so that every video we put out, you'll be notified. So until this next time, stay classy, my friends.